John Griswold here with Griswold Group. I'm excited to fill you in on what's going on in San Diego with the real estate market. So, if you've been tuning into my videos, you've been aware that we've had an increase in inventory this year and demand has really remained flat, and that's really been a multi-year trend driven by interest rates. So this year we've seen interest rates fluctuate about 50 basis points one direction or the other. So really we're seeing about 6.6 on the low end, maybe 7.15 on the higher end. Not high enough to really drop values in a big way, not low enough to increase values in a big way. And so we're sort of just plodding along. We've gone up about 3.5%. Now we're starting to creep back down. If things remain sort of where they are with rates, we may end up with, about flat in terms of value growth for the year, maybe a few percentage points down. That's kind of the trajectory that we are experiencing right now. And so we're at a crossroads of, we could go one of essentially two directions. If rates stay where they are, between 6.5 and 7, that's going to be due to essentially some strength in the economy, meaning that the jobs market and unemployment remains low. We're not seeing big changes in inflation, and so everything is allowing the Fed to basically do nothing, in which case the market may continue to float down in terms of values a little bit at a time. The alternative is that we start to see cracks in the economy, and those cracks would be more unemployment, negative consumer confidence, those kind of things, tied together with lower inflation data, which would allow the Fed to start dropping the federal funds rate, which would then have a positive would help long-term interest rates like housing interest rates drop. And if that happens, we could have rates that are below 6.5, even below 6 for duration. That will definitely accelerate the speed of the real estate market because all of the demand will come rushing back. Who's not in the market right now? In general, it's millennials and Gen Z. In mass, a ton of demand that's on the sidelines, waiting for affordability to improve. And if and when that happens, you're going to see the market really heat up, values rise, more competition, that kind of thing. So that's kind of where we're looking. If I actually break it down into different segments, detached homes are doing better right now than the condo market. Condo market's pretty slow. It's all slow, but if a detached house is taking 2 to 3 months to sell, condo, you got to add an additional month on average to get that same to get something sold in the same kind of zip code, same neighborhood. So you definitely need to be patient right now. The demand that is in the market is much more focused on detached homes than condos right now. The other interesting little thing is that super luxury, like north of 4 million, is a little bit better this year than last year. There's the inventory is a little bit lower, and there seems to be more buyers in the market. And so right now we're actually seeing that there's a little bit more movement in the super luxury space right now. So hope all this is helpful, and I'm happy to talk to you on the next one.